morning, and how do you do, ladies and gentlemen? My name is Seth Julian. Our briefing, which is going to take a look at the results of and possibly, how we can to exploit an opportunity is generally considered to be rough waters. Here's the simple proposition. This is a chart, a price to year U.S. bond, U.S. 10-year bond. And, no, I'm sorry, this is the 2-year note. It's not the 10-year, it's the 2-year note. So let's go to the 10-year, actually, since that's what we sell. It'll be largely the same. This is the we sell on the platform. We have two bond products. We have the 10-year German government bond. The bond I just showed you, this is the 10-year U.S. What I've superimposed this chart that I made disappear. What I've superimposed on this chart, line, which is the U.S. interest rate, declines in the U.S. interest rate on a long-term chart like this and correlate them to the history that underlaid them. This, of course, I guess would be 9/11. Yeah, it rebounds. We come into the great financial crash, low and low for nets. They start to raise in 2013. Then the market gets spooked, and it falls again. Here we are today. As interest rate rose to 4%, that's not the interest rate you and I. Funds rate, that's the rate at which banks borrow federal cash. You and I don't borrow federal cash. You and I borrow cash from our local banks. Anyway, the interest rate rises, and we see this over time because business is not particularly complicated. At least once you get over the fakakta terminology, it's counterintuitive and unhelpful. But suffice to say that when the interest rates go down, more desirable, and therefore their prices go up, and that's what we see in these charts. As inflation, interest rates start to go up, the value of these bonds. One asks, how can we possibly exploit this misery? You short the Eurobund and the U.S. 10-year. Okay, we'll just make these a little bigger just to see a little less data in finer detail. This is going back to July of this year. So I rest my case, okay? Do you think it's going to reverse anytime soon? It does not look that way. Now, just let me remind you all that these are speculations, and we could be wrong. In the capital markets that you can afford to lose, because lose you're going to do. Not necessarily all of it, not necessarily immediately, but it's part of our capital is always lost, and we lose. And in the process of winning more than we will lose. So it's part of the game, it's part of the business, and you have to be able to, take those risks and that's why you have to understand the risks before you get into those positions. But having said all that, and I don't say that in a smug manner, I take risk control seriously, and like all of us, have paid the price for disregarding it. Anyway, these are the bond prices. These go down in relation to rising interest. The Federal Reserve just announced yesterday that point again. These are huge jumps in a very short time. Look how steep that curve is. It's not likely to reach down a bit. In other words, the next jump may be a little further out and maybe 0.5%, of course, like it was yesterday. But rise it's going to do because the interest rate is effectively, let's call it 5-6%, and the market gets to around 9%. And then that's going to slow things down, and that's how it's done, unfortunately. It's a crude, blunt and series of instruments we have in our bag, but that's what there is. So this to us looks like one of real opportunities to exploit, given the rising interest rate and rising situation around the world. That's going to do it for now, ladies and gentlemen. I'm your host. You all, ladies and gentlemen, the ability to trade with confidence.